Welcome back to another episode of Profitless on Purpose, the nonprofit accounting podcast. I'm one of your hosts, AJ Wheeler. With me, as always, is Mark Pallardy.
Hey, everyone.
Got a great show. Article entitled Stop Telling Happy Stories. Made my head scratch a little bit. What do you mean? We always want to tell happy stories. This has to do with fundraising. How if you're just giving nothing but good news to your donors and your ask, and how that can affect and how it can actually drop how much people are going to give to you if you're only telling them the good parts about what your organization has accomplished. So how you can weave in the need and maybe not such a happy spin on everything can help your organization. We'll kind of give our pros and cons to that. You can imagine there's a little push pull there, of course. But and then we had a question come in that we thought deserved its own special place here because it had so much to unpack out of it. Fiscal sponsorships. What do you need to know about if you're going to take on a fiscal sponsorship in your organization, or if you're an organization that's just starting out and wants and needs a fiscal sponsor, what you should be thinking about? What are the pitfalls? How you should account for a fiscal sponsorship in your organization? How you should go about contracting with another? What type of other organization should you be fiscally sponsored by? Hey, what is even a fiscal sponsorship? We'll talk about it all, and we get quite deep into it this week. And then our last article for the week is what large unrestricted gifts are doing for leaders. So this talks about the big gifts that Mackenzie Scott gave recently and the effects it's had on the organizations that actually received them. And kind of a spoiler alert, large unrestricted gifts actually helped nonprofits do more. But we'll talk about how that is and what the evidence showed that they came up with on what these large unrestricted gifts did, not just for the organization, but for the leadership in those organizations. So anyway, Mark, you got our first article for us. Take it away.
Hey, thanks, AJ. Yeah, this first article comes from Philanthropy Daily, and it's called Stop Telling Happy Stories by Ian Bernhoft. And in this article, they're kind of talking about fundraising appeals and how different nonprofits are seeking donations. And oftentimes these stories depress how much people are going to give. In other words, you could be giving more if you structured your asks, your give letters in a different way. And they've done some research and found that some of the appeals that go out end up costing people money, costing organizations money. So he lays out a few problems that are happening there. One is that the appeal that you might make to your donors talks about a problem already being solved. So you might go into some song and dance. In this article, they talk about it's a kidney donation foundation, and they talk about a recipient of a kidney who, through their help was able to get help. And then at the end of the day, that person lived. Well, the author posits that if the problem's already been solved, in the donor's mind, they're kind of going, well, maybe I don't need to give because you're already solving problems on your own. Secondly, if the appeal relies on reason and not emotion or imagination. So we've kind of touched on this on a number of different podcasts when we talked about fundraising appeals. I think having numbers and having metrics is great, but you really want to go for the emotion. You want to go for the appeal that's going to get people to open their wallets and kind of give, at a time that they might not have otherwise given. You want to engage the mind in these abstract problems, and effectively you want to get people, in their feels, because otherwise, if you're just telling them these are my metrics, somebody can think logically about it and say, okay, well, maybe I'll give at this time of year, or maybe I'll give later, rather than giving right now. So problem number 3 is the appeal doesn't give the donor a heroics role in the story. So similar to this kidney issue, right? You're telling a story, the person, yada, 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 through the nonprofit's help, problem solved, they have their kidney, everybody's happy, but it doesn't let the donor participate in the process at all, right? Like if you create an appeal where we need your help, with your help, we can do X, Y, and Z. It's kind of that Sally Struthers, format of getting money. Please send money to wherever money's needed. That old SNL skit. So, with the with an appeal, you really want to include your donors, you want to include and engage them emotionally, and you don't want to have a problem solved. So that's where that lays. AJ, what do you think about some of those?
Yeah, actually, it's funny. Last night I was at it wasn't really a fundraising event, but it was a presentation given by an organization here in the Portland metro area that does, they do housing and kind of safe respites for adult children with, or adults with, and young adults with disabilities. So, think like somebody that has developmental disabilities and they need a place that they call home, are able to be autonomous, and but also in a community that provides them with the support that's necessary. So it was a very good, actually, it was nothing but wins that we heard about, right? They have these houses built. They have, their housing, they have a wait list of 37 people that are trying to get in there. And so it was success. It was very much success that they were touting out. And this, I want to make it clear, this wasn't a fundraising pitch. We were at like kind of a community gathering that happened to be hosted by this particular nonprofit. But I was thinking about this article while I was there, and it was kind of, I don't want to say counter to this, because everybody that was there all of a sudden felt like, what can I do to help? And really what they were talking about was, I was asking, because there were so many wins on the board in the presentation or in the, kind of welcoming thing, everybody in the audience was asking questions of where they needed help with. And surprisingly enough, in this, and I'm on a board for an organization that does the exact same thing, that houses adults with mental disabilities. And the crux of where they need help with is employment. There's not enough people to staff these group homes and these individual living situations. And so really the theme was, get a hold of your senators and ask them to increase bed rates and give us more stabilization grants that can allow us to increase the hourly rate of these employees. But I really think if it's a different like situation where, they talk about kidneys here, or if you think about like, another organization like a mental health organization or a food bank kind of situation, if you're focusing on the fact that like, how much you're bringing in and how many wins you have on the board, then I think that leaves that open to like, well, I guess they don't need our help, which is kind of counterintuitive to the way that you usually present information from, if I'm presenting financial information, I want to let them know the good and the bad. And I'm usually going to lead with the good. What do you want first? The good news or the bad news? Or if there is no bad news, I want to lead with good news and then what we can do better to try and balance that out. I don't want to make everything seem rosy and then have somebody come along later, there be a problem or a roadblock or something like that. Well, hey, you never let us know about this. So I think it's important to give the good with the bad. But from a fundraising kind of perspective or from a fundraising angle, if you got one shot, and a lot of these things they talk about like elevator pitches or getting in front of donors or grantors, you really need to make it apparent at how much their donation is going to help and where you're lacking. If you're not communicating that, then nobody knows how to help, And so I think it's a twofold thing, right? You want to make sure that, like, hey, we're not on the outs and outs and about to close the doors and, oh my God, the sky is falling and, nobody's going to get kidneys if we stop or whatever. Like the article here kind of talks about the specific kidney harvesting stuff. But I also don't think you should make it seem all roses and, hey, we're fully funded, anything that you donate is on top, because donors, especially like high value donors or people that are very involved in philanthropy, have a finite amount of donations to give out. And if they feel like your organization is spoken for as far as like being, like this is just going to be a cherry on top. I'm sure they have 5 to 8 other charities that they're thinking about that maybe do the same thing or in a different area that they like to contribute to, and they're thinking, those organizations could probably use those funds much more. Same thing would be true in a grant writing situation. If you seem like you're on top of it all, and they have another organization that maybe is going about it a different way or is able to present their story in a way that kind of tugs at heartstrings and gets that funding to them, then they're always going to choose the one that maybe it is showing more need. And I think it's really getting across and messaging the need for that money and the need for the donation or that sponsorship. So accurately describing your wins, but also accurately describing how people can help. I think is, you just have to articulate both. I think, it shouldn't all be doom and gloom to me, but.
No, I totally agree with you, AJ. And I was going to bring this point up, and I think you laid it out nicely. The other thing I worry about is appeal fatigue, right? Because I think back to the 80s and when there were all these ads on TV for children starving in Africa, and you would see the kids with the bloated bellies and the flies all over their face, and it was just tragic and horrific. And the first time it really tugs at your heartstrings. But if every appeal you get is this doom and gloom, terrible sadness coming through and pulling at your emotional heartstrings, there's a point where you just get inured to it, where you just turn your emotions off and it's seen this, right? So I would say mete out your appeals, right? If you're going to somebody who actually already has given money for the year, don't dial up the doom and gloom on every single appeal letter. Talk about your wins, because frankly, a donor wants to see that their money is being used well and is going to good. And if they've given a big chunk of change and you are still saying, but we're in dire straits, then they're going to feel like, well, nothing I'm doing is helping. So there's the flip side to that too. So no, I think you're absolutely right. I mean, this is it's interesting advice for fundraisers who don't necessarily think this way, but I think you need to know your donor base and act accordingly.
I know I, for one, can't listen to In the Arms of an Angel anymore without thinking about poor dogs, and I think everybody out there has probably seen that commercial, and it's like, hey man, I've given a S ton of money to the AICPA or whatever, to help these dogs, and I still see them on my TV. Come on, man, where's my money going to?
Poor Sarah McLachlan. She'll never live that one down, right?
Never. For such a beautiful song, it sure is pigeonholed for sad pictures of dogs and cats. I just the mental association. Yeah. If you close your eyes and listen, you'll see the imagery of poor dogs and cats with that song. But yeah,
they figured out their appeal there.
Boy, yeah, synonymous, I guess. But yeah.
So we've got our second article, AJ. We're doing something a little different this week. So why don't you take it away?
Yeah. So I had a question come in, and it was revolving fiscal sponsorships. And the question was pretty simple. They had just some very generic questions about hey, listen, is my we've taken on a fiscal sponsor, and we'll explain what a fiscal sponsor is here in a second. But we brought on a fiscal sponsor, and I need to know how to put them into the accounting system. Do I consider them a vendor? Do I consider them a recipient, a customer? We're really talking about, how do I categorize them? Do I categorize them as a customer bringing money in, or do I categorize them as a vendor for money going out? And so I was like, wow, that question is pretty deep, given that it was only 2 lines. And I think there's a lot more behind that. So we thought we would take this part of the podcast to kind of answer that question, and at the same time kind of educate what fiscal sponsorship is, best practices, the pitfalls of what fiscal sponsorships can do. So I found an older article that lays it out pretty well, I think, and is still relevant today. It's an article back from 2020. And actually the article was first posted in 2016, but I think it's still relevant. We'll link it in the description, but it's from Nonprofit Quarterly, and it's written by Gene Tagai. And it walks through what a fiscal sponsorship is and how it works. So first, let's talk about what a fiscal sponsorship is. And I'll talk about in layman's terms. Usually when a nonprofit starts up, when you're a newer nonprofit, you may not have your 501c3 determination letter yet, but you've received a grant or you've received sponsorship from donations, but you don't have a 501c3 letter yet. You can't really accept that, and you probably are just a one man or one woman show at this point, so you don't have a fiscal department to spin up and start creating checks and hiring people and all that stuff. So essentially what you do is you ask another nonprofit to come under their umbrella of their 501c3 and essentially run there's two different kinds of ways it works. Comprehensive, in which all asset, liabilities, and exempt activities collectively referred to as a project are housed within that other 501c3. Or there is kind of the other model where you're kind of pre-approved grant relationship in which the product is run by a separate entity funded by the fiscal sponsor. So this would be very much like, there's a new nonprofit starting out, or you subcontract with a nonprofit to perform a program that you're getting granted for. So this often happens in I have a client that's in the mental health space, and they wanted to expand their services into getting mental health patients that are on the streets, not only the care, but also navigate housing them and getting them off the streets. And so that's not something they do. So they were able to partner or fiscally sponsor with other organizations that do that. So there's these two models. I think the one that most people are most kind of know about, or is probably the most common, is the comprehensive one, the Model A, where you're a new nonprofit, you have some money coming in, and you're being housed under the 501c3 umbrella of another organization, and they're acting as your bank account, expense paying, and kind of helping you run the program, but you are, launching yourself into a new nonprofit. So how it works, we talked about it in the comprehensive model. Like I said, they're entering into a fiscal agreement, sponsorship agreement, and you should all be written contracts. You need to have a written contract with your fiscal sponsor and the sponsoring agency. But essentially, your fiscal sponsor is giving up all ownership and control of the project to the sponsor and retaining the right to enforce, amend, or terminate the agreement and have the project transferred to another qualified fiscal sponsor. What that means is that you're at the mercy of the delivery of the sponsoring organization, meaning you can run the program or whatever you're using your grant funds for or the donations for as they came in to see it, but you're really at the mercy of the sponsoring organization. The other one is the pre-approved grant. This works very much like a program or an offshoot of the sponsoring organization. And so the pre-approved grant relationship almost works like a separate program. It's just that you're doling out money. The sponsoring organization is doling out money. It's almost like a separate, they're granting money to another organization to perform the program or the reason that they have this grant relationship. So if anybody works in federal funds, it's very much like subrecipient or subrecipient monitoring. But instead of it being part your organization, part the other organization, it's completely the other organization. And then you're overseeing the requirements of that grant. So how does it work? And why would a nonprofit want to be a fiscal sponsor? Well, first of all, altruistically, they want that other nonprofit to succeed. It's something they believe in. And so they are going to, help them by, essentially acting as a bank account for them and a bill payment for them, and perform administrative duties to make sure that they can accept donations and pay bills without having to run around and set up bank accounts and get their 501c3 designation and have a board on board to sign off on these things, and controls are in place, all of that good stuff that you need in a nonprofit. What you're doing is you're shortcutting that, and you're using another established nonprofit to provide those services for you. So what does the nonprofit that's sponsoring get? Well, they get an administrative fee, which should be in the contract. And what it does is it takes a percentage of the grant funds or net income or net revenue from the nonprofit to be able to pay the expenses that they're using, the administrative fees, to essentially run the finance and accounting and the ins and outs of that nonprofit for you. And so that's negotiated. But yeah, you think about things like insurance, workman's comp, adding people to payroll or having somebody actually physically write a check. That all costs money to be able to do that, and administrative time. So that's kind of the rub on a fiscal sponsorship. You're going to be paying another nonprofit to be able to manage these things for you. And then kind of if we look at like where things can go wrong, of course, there can be butting of heads when, like you have essentially two organizations or two nonprofits that are working together. Timelines may get blurred. I mean, you're paying the administrative fee, so that can kind of be a push and pull. But also, too, who's managing what? At the end of the day, if the sponsoring organization isn't looking at the requirements of the grant, and the new 501c3 is trying to buy Ferraris or expensive vacations to Hawaii with donor money or grant money, the fiscal sponsor needs to ensure that the guidelines are being followed because they're falling under their 501c3. Also, if a fiscal sponsor neglects its responsibilities, a project can be operated in a manner inconsistent with applicable laws or is beyond the sponsor's capability. So it can come back to haunt the sponsor and its leaders if the project results in an unexpected liability, like a lawsuit, penalty, or fine. There can be additional like registration, licensing, or reporting requirements. Or if it falls outside the sponsor's stated purpose and its governing documents, meaning it's outside, you have to have a like-kind nonprofit. You can't be like, we'll use the example from our early article. You can't be the ASCPA for protection of the pets or, like cats and dogs, and then do an addiction, physically sponsor an addiction rehabilitation center. Those things don't match. It's not part of the exempt purpose of the sponsoring organization. So you need kind of like in the same lane, and that fiscal sponsorship should line up with your exempt purpose. It can't be completely off base. And what that tries to do is it tries to, kind of compact rules and regulations. You want somebody that knows what they're doing. The same way you wouldn't hire like a divorce attorney to file your incorporation of your nonprofit. You need somebody that knows what they're doing in that space. So from like and just to wrap this up, I know I've been rambling here a bit. I think fiscal sponsorships are the lifeblood of starting a new nonprofit. So I want organizations that are listening to this to take this into account. The more the merrier is true when it comes to nonprofits. There's enough pie out there for everybody to get a slice, and you promoting and propping up new nonprofits, I mean, they all have to start somewhere. So this is really it's a noble thing to undertake, but realize that it takes some time, effort, and not to rush into these things half-heartedly, because there can be real ramifications towards your organization. And from a fiscal sponsoree side, you want to make sure that you're aligning yourself with a nonprofit that's reputable, knows what they're doing, isn't going to take tons of money here through the administration fee that they'll charge, and they're aligned with what you want to do and understand the project that you're bringing to them, that you're housing underneath their 501c3. So Mark, I'd love to get your input. I know I rambled way too long here, but if you have any questions about fiscal sponsorships or see something I forgot here, please jump in.
Yeah, I took a couple notes while you were yammering on. Just a couple. I think you handled that well, and you described it well. A couple things. I've been through fiscal sponsorship. I'm on the board of a nonprofit right now, and we started out with a fiscal sponsorship. Very similar to how you were describing this. We were in the process of getting our 501c3 and wanted to still be able to have our donors to the program be able to have a tax deduction. Now, when you're applying for a 501c3, if you're approved, that those charitable donations go back to the date of your application. So it wasn't really necessary, but the fiscal sponsorship was a way to basically CYA. In case we weren't approved, those donors would still have their donations covered. But with these fiscal sponsorship agreements, it probably goes without saying, but I'm going to say it anyway. Get an attorney involved, right? This is complex legal paperwork. There are going to be aspects of this specific to your organization that you're not going to think about. You're not going to be able to look at a boilerplate from another organization or get something offline to feel confident that your state laws, the federal laws are all being aligned with. There's another thing this article kind of brought out, that there are some organizations that just do lots of fiscal sponsorships with smaller organizations and have a revenue stream from administrative income. Don't do that. Just be careful, because at the end of the day, the fiscal sponsor is responsible for everything going on. And if you're not fully involved with the books of the person you're fiscally sponsoring, how many times do I have to say that term? Then you could run into some real trouble. And for those being fiscally sponsored, they also have to realize that ultimately the fiscal sponsor has the say, right? So if they bring in a nice donation and the sponsoree decides they want to do X, Y, and Z with the funds, but the fiscal sponsor says, no, we actually want to see the funds going in this direction. It's the fiscal sponsor who gets to dictate where those donations or where those funds go to. So I think it's really important that you have your ducks in a row, trust who you're getting into fiscal sponsorship with. And I would also suggest have a clear delineated on-ramp and off-ramp, right? I don't see this as a long-term sustainable thing that you should stay as a fiscal sponsor under another organization forever. Sometimes, like with these grant things, it's a project that when it's done, it's done. But if you're limping along a fiscal sponsorship for years, it might be worth your while to just go for your 501c3 and get some independence from that. You could even share costs with the parent organization for payroll, et cetera. But ultimately, I don't know. I don't necessarily see these subcategories as being beneficial to the lesser party, if you will, because they're always going to be under the thumb and the control of the other organization. And I think a point AJ brought up late in the problematic things is making sure that you have sort of a like-kind organization. And you also run the risk, because if you're close but not quite, right, you might run the risk of our good old friend UBIT, right, unrelated business income taxes. So, if you're doing a program and you're fiscally sponsored under another organization, if it's not within their wheelhouse or within their mission and vision, they could end up paying taxes on the revenues that you bring in. So, I know I'm throwing a lot of different things at the wall, but I just was like, wow, a lot of good points that AJ brought up. So, I think that's what I have to say. So buyer beware.
Well, and I think, we could probably do a whole podcast just related to this, because there's so many pitfalls and ins and outs of being either a fiscal sponsoree or a fiscal sponsor that there's a lot of nuance here, right? Just really quick things we haven't, things that you probably want to have in your memorandum of understanding or in your kind of like fiscal sponsor document is like who's providing reports, who's giving, who's gonna like make hard decisions in that. What are the bright line kind of separations between administering a project and how you report on that, and back to a grant or if there's a grant involved. All those things need to be kind of it is almost like setting up a new nonprofit anyway, because you have to be working with an organization that's already very concrete in what they do and somebody that is new and maybe doesn't see these things. So like Mark said, please get a lawyer involved and please, hash this out. And you want to try and relieve that fiscal sponsorship as quickly as possible to be able to be on your own, in a distinct amount of time.
AJ, while we're here, since we're kind of wrapping up our topic of the week with this article, let's just revisit the question and see if we've answered what the questioner asks.
Sure. So what the questioner was asking was whether or not this fiscal sponsor should be a vendor or if they should be considered a customer. And what they're talking about specifically is in QuickBooks, if they should be recognized as receiving money in under that organization's name, or if they should be a vendor and you're, essentially expensing everything out. I think great point, because I don't think we've made it to that part we're in our rambling. And I would say they're going to be both, because they're going to be receiving money in and you're going to be exiting money out to them. So you're going to have to create two. The way that they would be a customer is if they're receiving donations and then they're bringing you these donations that are being brought in. But those need to be tracked to understand if they're restricted or unrestricted. And they should probably be recorded under the name of the person that's bringing in the money. So if they've got a grant, that grant needs to be recorded for the granting agency that the money is coming from. Because realistically, you're going to be running a separate set of books. Essentially, what I would recommend is having a class in QuickBooks to track this fiscal sponsorship. It's not fundraising, it's actually a program. So it needs to be in your program categories. It's not administration. Well, the fiscal sponsorship fee would be administration costs for you. Just like any other admin allocation or whatever, you're going to recognize that expense as revenue in administration. But overall, the fiscal sponsor is going to be a separate program, or however you're tracking grants or programs in your organization, it's going to be a separate GL listings or a class. And it's going to have, and if you're a fiscal sponsor, you're going to be writing checks on behalf of them. So checks going out to other vendors, suppliers, even payroll. You're going to have to figure out how those are going to be paid, and each one of those are going to be vendors. You're going to be essentially creating a profit and loss statement, possibly a balance sheet if they have their own banking income and assets or liabilities set up that you're going to need to track separately. And you got to figure out how you're going to report those things, because what you're going to do at the end of the fiscal sponsorship is you're going to remove all of those assets and liabilities out of the book of the sponsor, and they're going to open up a new set of books outside of yours. So that transfer of assets and liabilities and essentially the history of what has happened in that organization when they spin out from underneath their fiscal sponsor is going to need to be known. So the best advice I can give is make sure you keep all of those transactions separate from the rest of the nonprofit and are able to access that information for the life of that sponsorship, just like you would a grant for the life of that sponsorship, to be able to then, eventually spin them out. Or God forbid they collapse and this doesn't work for them. You then have to you're under the fiscal sponsorship, it really acts like another program or piece of your organization, and you would have to absorb all those liabilities and assets into your own organization if that other fiscal sponsorship, the sponsoree, fails. So there is two parts to this, success and failure, but both require that you need to house that separately from your own set of books. And the easiest way, we've talked about this before, is using the class system or department system in your accounting system. But if you use GLs, codes, you would need to do the same thing, just like it's another grant or program.
Yeah, and I would also just say, beware as the fiscal sponsor that you're making the connections and the agreements with the vendors effectively when somebody in a program does. So if they, spend more than they're allotted, or they, contract with a vendor for AP and at the end of the day, they run out of money, you're going to be the organization that the vendor is going to come back to, because you're essentially fiscally sponsoring. It's like co-signing on a loan, or it could be. So, I've seen fiscal sponsorship situations where there is no bank set up separately for the fiscal sponsoree. It is all being done in-house, where there is somebody signing checks and doing disbursements on the fiscal sponsor's part. So have awareness of that, and just like co-signing a loan, make sure you're trusting who you're getting into this relationship with.
Yeah, absolutely. Great points, Mark. And I think, the trust goes both ways. You as a fiscal sponsoree and a fiscal sponsor, you have to be able to trust the organization and all of the thoughts about ethics and being on task and on project and on the nonprofit mission of what they're asking needs to be there, as well as following the grant regulations or the donor intent behind those. It all falls back to the sponsor. So you need to make sure that whoever you're partnering with in this fiscal sponsorship is reliable, ethical, and on the ball on what they're doing, and understand this. And the sponsorship has to get their arms around that as well. Yeah, it can be the greatest thing ever, or it can be the worst thing ever that your nonprofit goes through. And I've seen both sides of that. So just be aware. it's a very altruistic thing to do as a nonprofit because you're helping somebody else enter this world and create a new nonprofit that can go out there and help a constituency. But it can also be one of the most nerve-wracking things if you're caught up in a bad situation with a bad, essentially a bad fiscal sponsoree. So just be weary from both sides and take things slowly and methodically when you're going through this, and make sure you're crossing all your T's and dotting all your I's, because it happens a lot and a lot of people rush into it and there's a lot of pitfalls there. So, but yeah, I think we've probably beaten that, topic to, we've beaten it clean. I think everybody should know about it. If you have questions, feel free to ask. We'd love to talk more about it. But Mark, you got our next article for us here.
Yeah, our third and final article comes from our good friends at the Stanford Social Innovation Review, and this is called What Large Unrestricted Gifts Do for Leaders. So this article kind of has done, there was a research study done, and this is kind of the analysis of it, for these large gifts that were given in 2020, 2021 by Mackenzie Scott. So she, if you remember, is Jeff Bezos's former wife, and she walked away from that marriage with billions of dollars. So she decided she was going to start making huge donations to nonprofit organizations, some of whom didn't even apply for the funds, and a lot of whom were organizations where the head of the organization was a person of color. So this analysis looks at what happened when that happened. So prior to her donating this money, the median grant size for these large donor grants was about $100,000. In the years 2020 and 2021, when she started giving these grants away, the median grant size was $8 million. So this is a considerable uptick in people's revenues. And to further put a point on this, which if you've listened to this podcast, you know how great this is. They were all unrestricted money. So she didn't put any strings attached. She just said, I trust your organization. You do what you think is best with this money. And my goodness, what a gift if you were one of those recipients. So in looking at that, they wanted to see what the impact was, not only on the organization, but what it did for the executive directors or the leaders of those organizations. And no surprise, the research found that in addition to truly impacting the organization, it was transformational for the leaders themselves. It affected them both personally and professionally, and it kind of was able to shift the leaders' thinking, emboldening them to dream what's possible, because all of a sudden they weren't trying to just figure out how to make their monthly nut, if you will. They were really able to expand and say, okay, we have these resources now, we have these assets. What do we want to do? They could spend their time thinking about where they can make the greatest impact for their community and for their organization. And fully 3/4 of the leaders discussed that they had a shift in their thinking, and that obviously this was a shift for the better, and that it gave them opportunities to innovate and take risks, and basically all sorts of things. And also, because a lot of these people were women of color, it made these organizations and these women of color feel like an asset and a liability, because prior to that, the metrics showed that organizations run by a woman of color were receiving less funds from organizations and from large donors. So she really flipped the script on what was possible and what was happening in the space. They also, interestingly, one of the subsets of this is that the nonprofits who received the gifts from Mackenzie Scott showed an increase in fundraising, right? It's the kind of the get on board, everybody, right? Because Mackenzie Scott thinks this organization is worthy and she's somebody with a lot of money. So all of a sudden, fundraising increased because people think that this is a worthy gift or worthy cause, and it really increased the nonprofit in those ways. So I think that's a good ending. It's kind of ending the podcast on a happy note, because it really feels like it was a win-win all around and really impacted these nonprofit leaders for the positive. AJ, your thoughts?
Well, yeah, I think when I read this article, I was thinking, well, duh, like this is something we've been talking about for a long time. I don't know, we've kind of been beating the same drum. I mean, in working with the amount of nonprofits that I've worked with over the years, the main thing, I shouldn't say it's not difficult, but it's easier to find funds to fund a program, right? And if we're, and that goes from grants, like foundation grants all the way through to governmental grants to state and local grants. If you have a project, and because usually it happens like this, you have a grantor or a government agency that needs to do something, right? They have this allotted money that they need to do something with. And so your organization presents a program that you can support what they want to do. So it's a perfect match. The problem is we've talked about it before, admin allocations or the amount of unrestricted funding that you receive from those type of arrangements is at best more than 10%, but usually rule of thumb is you get 10% of that grant for administrative costs. So the way that you can cover your admin funding is by unrestricted donations, which are very hard to come by, but usually they're personal donations from a person that likes your organization and is able to give you an unrestricted grant. So you have that, but those are very time consuming to undertake. And the other way is the administrative allocation that you get from grants, which is usually 10%. I mean, that's been industry standard for as long as I've been in the industry. So to be able to cover, if you're looking at for round numbers, right, you have $100,000 worth of administrative cost in a year. To be able to fund that with 10%, you have to have $1 million worth of grant funds in that year to be able to just cover break even for administrative. What that does is you're constantly fundraising just to and scraping and trying to add more programs and grants, which requires more administrative tasks to be able to cover your current administrative load. It doesn't, and when you're applying for these grants, you're not able to try something new. You have to go with true and tried, tested programs, approaches that are going to satisfy the wants and needs of the grantor or the state and local government. So it doesn't provide any kind of incubator or innovative thinking or new pilot programs. It's not an environment that's rich with that. I'm not saying you can't do it, but it's not top of mind when you're trying to gather grants. Now, if you're way ahead and you want to try something, that's a possibility. Or if you have somebody that really believes in what you're doing, maybe, but it doesn't, that's a risk. It's a huge risk. And when you're looking at the risk assessment from an administrative point, sometimes it's not worth taking. Let's sock that money, unrestricted money away and use it for a rainy day. But when you're given a grant like this, you're able to innovate. And we don't see a lot of innovation in the nonprofit space from older established nonprofits because you don't win grants innovating. You win grants, doing the tried and true that you have metrics to show that work in your service area. So I think it's great. I wish more people would look at this, you know what I mean? And, if you trust a nonprofit enough to give your money towards a specific program, you should be able to trust them enough to give them unrestricted funds to be able to try something new. They have a track record. You trust the organization. You've talked to the fundraising. You know the staff there. If you're willing to give them a gift, I would argue that you should try giving it unrestricted so that they can do something more with that money than just rechurn what they're already doing. If they're successful, they'll be able to come up with more grants and donations to do what they're already doing with a proven track record. But you can really make a difference by providing them an unrestricted funds to be able for them to try something new or dream bigger about something that they have always wanted to do, but may not have been able to. So I think it's a fascinating kind of alignment of data with what we always thought. And I think hopefully there's a shift more towards this, I mean, of course the pendulum can swing too far the other way where, nonprofits are flush with cash and trying all kinds of weird stuff, but I don't see that happening anytime soon. So
yeah. Preach, Brother AJ. I can feel the music swelling in the background as you're telling people,
they
give unrestricted money. We need it.
I should be a fundraiser, not an accountant. I don't know, but yeah.
Yeah, I know. Recently, just to follow up on this, a couple of years later, but Jeff Bezos has said this past week that he wants to now start giving away some of his billions as well. So, hopefully this starts a trend and we see more of this, because watching these organizations kind of have these epiphanies, having these kinds of shifts in thinking is only going to help them, even if these huge amounts don't come into their specific organization again. Just creating the new mindset can certainly be helpful. So hopefully we've succeeded in shifting your mindset today. And we certainly appreciate you joining us for another episode of the Profitless on Purpose podcast. On behalf of AJ and myself, thanks for joining us. Feel free to reach out to us on Twitter at ProfitlessPod, make comments down in the YouTubes, get in contact with us if you have your own questions. And, we'll see you next time here on the podcast.
Thanks, everybody.